One decision in 1694 reshaped how nations would fight wars, build empires, and control their own futures forever. What happens when a government, desperate for money, makes a deal that gives private bankers the power to create currency itself? This is the story of an invention that would define the modern world, an institution that turned debt into money, promises into power, and citizens into creditors of their own government. In the summer of 1694, England was broke, at war, and losing credibility with every passing month. King William III needed £1.2 million to fight France in what historians would later call the 9 Years' War. But Parliament refused to raise taxes any higher, and traditional lenders had lost faith in the Crown's ability to repay. The country was in a bind. Every European power was locked in military competition, and wars were becoming more expensive, more complex, and more dependent on sustained funding. England's traditional methods, confiscating wealth, debasing coins, or begging loans from Dutch and Italian bankers, had reached their limits. Then, a Scottish merchant named William Paterson proposed something radical: create a private bank that would lend the government money in exchange for the right to issue banknotes backed by that same debt. This wasn't just a loan, it was the birth of modern central banking, the blueprint for how money and power would intertwine for the next 3 centuries. But to understand why this mattered, we need to look at what England's financial system actually looked like before this moment, and why it was failing so badly. England in the 1690s ran on gold and silver coins, clipped and worn thin from decades of use. The problem was simple, but devastating. There wasn't enough money to match the economy's growth. Credit was chaotic. Goldsmiths, originally craftsmen who worked with precious metals, had evolved into primitive bankers. They would accept deposits of gold and silver, then issue paper receipts that customers could use like money. These receipts circulated around London, but they were only as good as the goldsmith's reputation. If a goldsmith went bankrupt, the notes became worthless. Merchants traded in foreign currency, Dutch guilders, Spanish dollars, French livres, because English coins were so unreliable. The problem of clipping was epidemic. People would literally shave thin slices of silver or gold off the edges of coins, then spend the coin at full value while keeping the metal shavings. Over time, coins became so degraded that some weighed half their official value. But the deeper crisis was trust. The Crown had defaulted on debts before, most notably in 1672, when Charles II simply stopped paying creditors. An event called the Stop of the Exchequer that wiped out fortunes overnight and destroyed confidence in royal borrowing for a generation. Interest rates for government loans had spiked to 14%, sometimes even 20%, and even then, lenders demanded collateral the king didn't have. Private citizens could borrow at 6 to 8%. But the government, which should have been the most creditworthy borrower, paid double that rate, because no one believed the Crown would honor its obligations. Meanwhile, England's rivals were innovating. The Dutch had created sophisticated bond markets and were funding their wars at interest rates half of what England paid. Amsterdam had become Europe's financial capital, because investors trusted Dutch institutions to repay debt. Beneath all this, a deeper structural problem was building. England had no systematic way to expand its money supply when the economy grew. Trade was booming, imports from the Americas, exports to Europe, the beginning of global commerce. But the physical supply of coins couldn't keep pace. This strangled commerce and made every military campaign a scramble for cash. Armies couldn't be paid, ships couldn't be provisioned, and the government was constantly on the edge of financial collapse. The stage was set for a revolutionary idea, not because someone was particularly clever, but because England was desperate enough to try something that would have seemed insane just a generation earlier. In early 1694, William Paterson and a group of London merchants presented their proposal to Parliament. The pitch was straightforward. They would raise £1.2 million from private investors and lend it to the government at 8% interest. In return, these investors would form a corporation called the Governor and Company of the Bank of England, with the right to issue banknotes to the public. Parliament debated the plan for months. Some members worried it would create a dangerous concentration of private power. Others argued England had no choice. Without this funding mechanism, the war would be lost, and with it, England's position in Europe. The Whig faction, which represented commercial interests and urban merchants, pushed hard for the bank. The Tory landed gentry opposed it, seeing it as a threat to their traditional dominance. The deal passed Parliament on July 27, 1694, and by August, the subscription books opened to the public. This is where something remarkable happened. Within just 12 days, ordinary merchants, widows, shopkeepers, even some artisans, had pledged the full amount. It was the fastest capital raise in English history up to that point, a staggering show of confidence that revealed how desperately England needed a financial solution. The subscription list itself survives today, and it tells a fascinating story. Over 1,200 people invested, ranging from small sums of £500 to massive commitments of £10,000 or more. The king himself subscribed £10,000. Merchants, professionals, and wealthy widows dominated the list, but there were also modest investors, people putting their life savings into this untested experiment. The bank opened for business on July 27, 1694, in Mercer's Hall, a rented building in Cheapside, in the heart of London's financial district. It had just 19 staff members, a governor, deputy governor, and 17 clerks. The entire operation could fit in a few rooms. Its first governor, Sir John Hublin, was a merchant whose family had fled religious persecution in France decades earlier, Huguenots who had built a new life in England through trade and commerce. That detail mattered more than it might seem. Trust in the bank depended on its perceived independence from the crown. Hublin wasn't a nobleman or a royal favorite. He was a self-made businessman with a reputation for integrity. Here's how the mechanism worked, and this is crucial to understanding what made it revolutionary. The bank lent the government £1.2 million in gold, actual physical metal weighed and verified. In return, the government paid the bank £100,000 annually, $96,000 in interest, that 8% rate, plus $4,000 for management costs. But here's the innovation that changed everything. The bank could issue paper banknotes worth up to the amount it had lent to the government. Essentially, the bank was creating money backed by government debt. The gold went to the government to fund the war. The banknotes went into circulation as currency. And suddenly, England had doubled its effective money supply without minting a single new coin. Within months, these banknotes began circulating as money. The process worked like this. A merchant could deposit gold at the bank and receive a note, essentially a receipt saying, "The bank owes you this much gold." But instead of going back to redeem the gold immediately, the merchant could use that note to pay suppliers, who could either redeem it for gold or, more likely, pass it along to someone else to pay their own debts. For the first time, England had a flexible money supply that could expand with the economy. When trade increased, more banknotes could circulate, without waiting for new gold and silver to be mined and minted. This was fractional reserve banking in its earliest form. The bank held reserves of gold, but issued notes worth more than those reserves, betting that not everyone would demand redemption at once. But there was immediate controversy. Goldsmiths who had been issuing their own notes suddenly faced competition from an institution backed by law and guaranteed by Parliament. They argued the bank held an unfair monopoly and would ruin private credit. Within months, pamphlets flooded London, attacking the bank as a threat to liberty and free commerce. One goldsmith banker, Nicholas Barbon, led the resistance, arguing that the bank's privileged position would destroy competition and that its monopoly on government lending gave it dangerous political influence. He had a point. The bank wasn't just a commercial venture. It was becoming a quasi-governmental institution with power over the nation's money supply. The bank's early years were fragile and tested almost immediately. In 1696, just 2 years after its founding, England embarked on the Great Recoinage, an attempt to replace the entire degraded silver currency with fresh, full-weight coins. The government called in all the old clipped coins and promised to replace them with new ones at face value, absorbing the loss. This temporarily drained the bank of its reserves. People rushed to deposit their old coins before the deadline, but the new coins weren't ready yet. For months, there was a severe shortage of actual spendable money. Commerce nearly froze, and depositors, seeing the chaos, began to panic, demanding their gold back from the bank. The bank had to restrict withdrawals and suspend full convertibility, the promise that anyone could exchange notes for gold at any time. This was exactly what skeptics had warned about. When trust wavered even slightly, the whole system teetered on collapse. Angry crowds gathered outside the bank's offices. Merchants refused to accept banknotes, demanding gold instead. The bank was days away from failing. What saved it was government intervention. Parliament quickly passed an act making it a crime to refuse Bank of England notes for payments owed to the government, essentially forcing acceptance through legal tender laws. William III personally endorsed the bank in public statements, reassuring investors. And crucially, the government made its interest payments on schedule, proving it would stand behind its obligations, even in crisis. By late 1696, the crisis had passed. New coins entered circulation, confidence returned, and the bank survived. But the episode taught an important lesson. The bank worked only as long as trust held. That trust had to be earned through consistent behavior, legal backing, and visible cooperation between the bank and the government. Yet the bank did more than just survive, it grew. By 1697, its capital had increased through new subscriptions. Parliament renewed its charter with expanded privileges. The model was working. England could now fight wars on credit, borrowing from its own citizens through the bank, rather than begging foreign princes for loans at extortionate rates or resorting to desperate fiscal measures. The bank's role expanded in other ways too. It began managing payments for the government, essentially acting as the Treasury's banker. It facilitated trade by providing a safe place for merchants to deposit funds and transfer payments without hauling gold around London's dangerous streets. And it began discounting bills of exchange, short-term merchant credit, which helped smooth trade flows across the Atlantic and European markets. By the early 1700s, the Bank of England had become indispensable. Its notes circulated throughout London and increasingly in provincial towns. Government borrowing costs had fallen from 14% to 6 or 7, saving the Treasury enormous sums. And perhaps most importantly, England had developed a reliable way to fund sustained military operations, a capability that would prove decisive in the wars to come. The bank's founding charter is preserved in the Bank of England Museum today, and high-resolution scans are available through the UK National Archives. The subscription list, showing exactly who invested and how much, survives in manuscript form in the bank's archives, confirming both the speed and breadth of public participation. Contemporary pamphlets from the period show the debate was fierce and public. Some writers praised the bank as a public blessing and the foundation of England's commercial greatness. Others called it a dangerous monopoly, a creature of Whig politics, and the beginning of tyranny by moneyed men. Treasury records confirm the government paid its interest obligations on schedule for the first 3 years, without interruption, a dramatic break from the pattern of defaults and delays that had characterized royal borrowing for decades. We also have letters from merchants and investors discussing their experiences with the bank. One merchant, Thomas Papillon, wrote to a business partner in 1695 that the bank's notes pass as readily as gold, and with far less trouble to carry. It is a revolution in commerce. These personal accounts provide ground-level evidence of how the innovation actually functioned in daily trade. However, there are important gaps. We don't have detailed minutes from the bank's early board of directors meetings. Internal deliberations, debates about policy, and private discussions between the bank's leadership and government officials are largely undocumented or lost. This means some crucial decisions, like exactly how the bank managed the 1696 crisis internally, or what private assurances were given to major depositors, must be inferred from external accounts rather than direct documentation. We also lack comprehensive data on how quickly and widely bank notes circulated outside London. Most surviving records focus on the capital and major port cities, leaving questions about rural adoption and regional variations in trust. Not everyone saw the Bank of England as progress, and those criticisms deserve serious consideration. Critics argued it gave private bankers too much influence over government policy. Essentially, the people lending money could now shape how that money was spent, and potentially even influence decisions about war and peace. There was a real concern about conflicts of interest. If you're a bank shareholder earning dividends from government interest payments, you might oppose peace treaties that would reduce government borrowing. You might favor aggressive foreign policies that increase debt. The incentive structure seemed designed to make war profitable for a small financial elite. Some historians argue the bank's monopoly on note issuance actually stifled financial competition and innovation, delaying the development of a more diverse and robust banking system. Scotland, which didn't get a central bank until much later, developed a more competitive banking sector, with multiple note-issuing banks, and some economic historians argue this fostered more innovation and better service for customers. Others counter that England needed monopoly power to stabilize a chaotic monetary environment. In the 1690s, with multiple unreliable note issuers and degraded coinage, the priority wasn't innovation, it was basic trust and standardization. The bank provided that foundation, even if it came at the cost of reduced competition. There's also significant debate about how democratic or oligarchic the bank really was. The subscription list shows considerable diversity. Wealthy merchants, but also widows, professionals, and even some artisans investing modest sums. This seemed to spread ownership fairly broadly across the property classes. But the governing structure told a different story. The bank was run by a court of directors, initially 24 directors, plus a governor and deputy governor, elected annually by shareholders. However, voting rights were weighted by the size of holdings. And in practice, a small group of major shareholders dominated the board for decades. So while ownership was relatively broad, control was concentrated. Decisions that affected the entire English economy were made by a few dozen wealthy London men in private meetings. This was certainly more accountable than royal prerogative, but it wasn't exactly participatory democracy either. For ordinary people living in London in the 1690s, the bank's creation meant something immediate and tangible, stable paper money they could actually trust. A shopkeeper accepting payment could now take a Bank of England note without worrying it was forged, without fearing the issuer would go bankrupt overnight, and without the physical danger of storing large amounts of gold and silver. This mattered more than it might sound. London streets were dangerous. Highway robbery was common, and carrying significant sums in coin was genuinely risky. The bank's notes, backed by legal authority and widely recognized, made commerce safer and easier. But there was absolutely a darker side that can't be ignored. The bank helped fund wars that sent thousands of men to fight and die in Europe for years. The 9 Years' War, then the War of Spanish Succession, then conflict after conflict throughout the 18th century, all financed more easily because the bank provided reliable credit to the government. And the taxes levied to pay the bank's interest, to service the growing national debt, fell disproportionately on the poor. Parliament preferred indirect taxes on consumption, excise duties on beer, salt, leather, candles, soap, and other everyday necessities, because they were easier to collect and politically less controversial than land taxes that would hit the wealthy. A laborer's family in London might spend 15 to 20% of their income on excise taxes alone, while a wealthy landowner or bank shareholder paid a much smaller proportion of their total wealth in taxes, yet earned returns from government bonds. The financial innovation that made government borrowing easier also made sustained warfare more affordable for those making the decisions, while those fighting the wars and paying the taxes had no voice in either the bank's governance or Parliament's decisions. For the emerging merchant class, however, the bank was a tremendous opportunity. Those who bought shares in 1694 saw both dividends and political influence grow together. They became stakeholders in the government's success. A new kind of political power not based on inherited land or aristocratic title, but on capital, credit, and commercial expertise. This shift in the nature of power was profound. For centuries, England had been governed by a landed aristocracy, whose wealth came from agricultural estates, and whose political authority came from ancient family lines and royal favor. Now, a new elite was emerging, urban, commercial, globally connected, deriving power from finance rather than soil. The bank didn't create this shift alone, but it accelerated it and institutionalized it. Think of the Bank of England as a bridge between two different worlds. On one side, an old system where kings borrowed personally, based on their own reputation and dynastic prestige. They defaulted often when it suited them, and relied on gold and silver they physically possessed or could seize. On the other side, a new system, a system where government debt became a tradable financial asset, where money itself could be created through the process of lending, and where the state's creditworthiness became its most valuable resource. The genius of the bank wasn't just in the technical mechanics of fractional reserve banking or debt monetization, though those were important innovations. The deeper genius was psychological and political. By letting ordinary citizens invest in government debt, by making those investments tradable and liquid, the bank turned potential opponents into partners. If you owned bank stock or held government bonds, You had a direct financial interest in the government's success and stability. You wanted the government to win its wars, maintain order, collect taxes efficiently, and above all, keep paying its debts. Your personal fortune was now tied to the state's fiscal health. This alignment of interests between government and governed was genuinely new. In the old system, there was a fundamental conflict. The king wanted money, and his subjects wanted to keep it. Every tax or loan was a negotiation or a confrontation. But in the new system, at least for those with capital to invest, giving money to the government became an investment opportunity, not a confiscation. And that made sustained government borrowing possible, in a way it had never been before. This model spread rapidly across Europe and eventually worldwide. The Bank of France was founded in 1800, explicitly modeled on the Bank of England. The Riksbank in Sweden reorganized along similar lines. The Federal Reserve System in the United States, created in 1913, borrowed key elements: private member banks providing capital, a public charter, note-issuing authority, and a special relationship with the national government. Even countries that disliked British imperialism copied the institutional model because it worked. It provided a stable currency, facilitated government finance, and helped coordinate monetary policy across a growing commercial economy. But the lesson isn't purely technical. It's fundamentally about incentives and institutional design. When you give a private institution the power to create money, you create a permanent tension, one that every modern economy still grapples with. Who does the central bank really serve? The government that grants its charter and depends on its support. The private shareholders or member banks that own it and benefit from its operations. Or the general public whose savings, wages, and economic opportunities depend on its decisions? That question was never fully resolved in 1694, and it remains contentious today. The Bank of England also pioneered what economists call the fiscal military state, the combination of efficient taxation, reliable public credit, and powerful military force that allowed relatively small European nations to project power globally. England's population in 1700 was perhaps 5 to 6 million, tiny compared to France's 20 million, or China's 150 million. Yet England could raise and sustain military forces far beyond what its size would suggest, purely through financial innovation. This capacity to mobilize resources through credit, rather than just current taxation, gave England and later Britain a structural advantage in global competition that lasted for centuries. It's not an exaggeration to say the British Empire was built on the financial foundation the bank provided. The Bank of England revealed a simple but profound truth. Money is a social technology, and trust is its foundation. The bank worked not because of the gold sitting in its vaults, though that helped, but because people believed the notes were worth something. And that belief was engineered and maintained through law, institutional design, transparent procedures, and consistent behavior over time. It was essentially turning a promise into a tradable product. The government's future tax revenue, money that hadn't been collected yet, from economic activity that hadn't happened yet, became the collateral for money people spent today. This trick, monetizing future earnings through debt instruments, is the basis of every modern financial system, from home mortgages to corporate bonds to sovereign debt markets. When you take out a mortgage, you're borrowing against your future income. When a corporation issues bonds, it's borrowing against future profits. When a government sells treasury bonds, it's borrowing against future tax revenue. The Bank of England didn't invent borrowing. That's ancient. But it systematized and institutionalized the process of turning those future promises into present-day money, at scale. But there's a serious warning embedded in this history too. Once a society learns it can borrow against the future, the temptation to overborrow becomes almost irresistible. England's national debt, which barely existed in 1693, grew to £60 million by 1713, then 78 million by 1750, and kept climbing throughout the 18th and 19th centuries. Each generation faced the same choice. Should we pay down the debt inherited from our parents, or take on more debt and pass the burden to our children? Almost always, they chose the latter, betting that economic growth would make the debt manageable. And often, that bet paid off. British GDP grew enormously over the 18th and 19th centuries, making even large debts sustainable. But the risk was always there. If growth stalled, if wars went badly, if tax revenue collapsed, the entire structure could implode. The bank taught the world that credit is a form of power, perhaps the most important form of power in a commercial society. But that power only works if you can keep servicing the debt. Default once and trust evaporates. Default twice, and you might not get a third chance. England learned this lesson the hard way in 1672, with the stop of the Exchequer, and the Bank of England was, in many ways, the institutional response to that trauma. A mechanism designed to make default politically and institutionally difficult. And that's still true 3 centuries later. So here's what we know for certain. In 1694, England created a private joint stock company with exclusive privileges to lend to the government and to issue paper currency. The mechanism worked because people trusted the institutional structure, and it fundamentally changed how nations would fund themselves for the next 3 centuries. And counting. What we don't fully know is even more interesting. We don't know exactly how much influence the bank's major shareholders had over government policy decisions, though we know they had access and relationships. We don't know precisely how the benefits and costs of this system were distributed across different social classes, though we have strong evidence of concentration at the top. And here's what remains genuinely uncertain. Was the Bank of England primarily a tool that concentrated power in the hands of a financial elite? Or was it a mechanism that actually distributed power more broadly by turning ordinary citizens into government creditors? The answer probably depends on which citizens you're talking about and which decade you're examining. For wealthy merchants and investors, it was clearly empowering. For laborers paying excise taxes to service debt they'd never voted to incur, the story looks quite different. But the biggest question isn't just historical, it's present tense, sitting right in front of us today. The template created in 1694 still runs beneath every modern economy. Every time a central bank adjusts interest rates, every time a government issues bonds, every time you use paper money or digital currency, you're participating in a system whose basic architecture was designed in a rented hall in London over 3 centuries ago. Looking forward, central banks will continue to dominate monetary policy worldwide, with institutional models directly descended from that 1694 innovation. Despite periodic crises and criticisms, the basic architecture remains the global standard. Every major economy operates this way, and there's no realistic near-term scenario where that changes fundamentally. As digital currencies and decentralized finance technologies continue to develop, we may see renewed debate about whether central banks should have monopolies on money creation. The question of what is money and who should control it, which was settled in most countries by the mid-20th century, is now being reopened by technological change. Some central banks are already developing their own digital currencies. China's digital yuan is already being tested widely. The Federal Reserve, European Central Bank, and Bank of England are all researching digital currency options. Meanwhile, cryptocurrencies and decentralized finance platforms are attempting to create money and credit outside central bank control entirely. Whether these succeed in displacing or merely supplementing traditional systems remains genuinely unclear. Most likely, we'll see hybrid arrangements emerge, where different forms of money coexist. The same fundamental questions from 1694 will resurface. Who controls currency creation? Who benefits from that control? How is trust maintained? These debates will just play out with new technology and new vocabulary, but the underlying issues are remarkably similar. The Bank of England didn't just solve an immediate financial problem for a government that desperately needed war funding. It created a template, a blueprint, an institutional model for how modern states would wield economic power. And that template is still running quietly and largely invisibly beneath every transaction you make, every loan you take, every investment you consider. When you deposit money in a bank, when you use paper currency or tap a credit card, when your government issues bonds, or your central bank adjusts interest rates, you're participating in a system whose basic architecture was designed in a moment of crisis and creativity over 3 centuries ago. The genius of William Patterson and the merchants who backed his vision wasn't just financial or technical, it was institutional. They understood that trust could be engineered, that money was ultimately a social arrangement, not a natural fact, and that the right institutional design could create power out of promises. They were right, and the proof is that their invention, refined, adapted, and debated for centuries, still shapes how the entire world manages money and power.